All right, I want to thank everybody for joining us here today. My name again is Wesley Boudreau, one of the senior financial advisors here with Wealth Enhancement Group. Formerly, we were the retirement group. We'll talk a little bit about that, the transition we had about a year ago. But kind of jump into this is more of a broad-based general webinar going over some different general 401k topics as far as retirement planning, budget planning, things like that, income strategies. So really, we're going to just scratch the surface on some of this. So ultimately, if you guys have questions, feel free to put those in or follow up and give us a call or give me a call directly. We'll try and get to some of these different questions, but chances are we might have more than what I can tackle, and we'll be happy to follow up with you on that. So let's get into, first of all, who the Wealth Enhancement Group is. We were previously the Retirement Group. I've been with the Retirement Group for 10 plus years. I've been in the industry for over 20 years. I can safely say the transitions I've made in the past when I've gone from one firm to the other is strictly trying to find the best options for my clients, and every step of the way I've done that. But I've been blown away with the Wealth Enhancement Group over this last year and a half or so. Really has got a fully diversified approach for our client base. It allows us to do a lot of things we weren't able to do before in-house versus referring out to CPAs or tax plan attorneys. Essentially, the question becomes, what can't we do at Wealth Enhancement Group on the financial side? Obviously it involves, investment management planning, tax planning strategies, estate planning strategy, life insurance planning, business planning, pretty much anything financial related that you have questions about. We can handle that for you, potentially in-house. There may be some unique situations we may need to refer out to a specialist or something like that. But the great news is we've worked extensively with a lot of those individuals, so we've got that expertise there for you. And really, it's a family office approach where it was a one-stop shop for everything you need. The data on here is a little bit outdated, a little bit stale, but you can see kind of the Barron's, the Forbes ratings. Those go all the way through 2025, where we've been typically a top 5 RIA firm, which is a registered investment advisory firm, an independent firm, which is very important because we are fiduciaries and we're focusing on providing the best options for each client, not selling any products or anything of that nature. As far as the key figures, this is showing 100 billion. We've actually surpassed over 130 billion by the end of 2025. Over 160 plus offices across America. That's been grown from a combination of acquisitions in different markets where we needed to add some space, and then also what we've done for our clients and existing client net flows and new flows. So we partner with Fidelity Investments and Charles Schwab, so we get a lot of different leads from that source as well. We're on one of their trusted advisory firms that they refer out to. So that's another aspect of our growth. But again, any questions on the company, feel free to just reach out, give us a call. We can kind of go through that with you. Let's get into some of the kind of information. One of the things you will notice, and you've seen historically with the Retirement Group, we've done, and we continue to do this, our kind of weekly educational seminars, whether it be something specific for your company, going over your pension plan, your 401k, Social Security topics, healthcare topics, tax reduction, estate planning, things like that. Again, we focus primarily on retirement planning initially, but now with the expertise of Wealth Enhancement Group, we've got a lot of different tax planning strategies at our fingertips for brokerage accounts and things of that nature, especially if you've got concentrated positions, want to unwind those. There's definitely a lot of strategies that we didn't have before that we now have access to. We also talk about your pension plan. Again, the Retirement Group started out working with a select few companies and expanded that, where our goal was to have each of our advisors, including myself, be experts, if you would, on a few companies. So that way we can hold your hand through that transition process, let you know how to manage your 401k, your pension, how to make the right decisions on when to retire, how to maximize the company benefits and things like that. We still do that. So any questions you have on an individual or specific basis, just reach out. We can definitely get into that for you. So when you transition to retirement, what's going to happen? I mean, you've been working for the last 20, 30, 40 years or so, and the question becomes, okay, I'm done. How am I going to get a paycheck? So a lot of different sources we tend to see are the core base is going to be Social Security. Obviously, you have that option to take it as early as 62 or defer it out to age 70. We can go through a full Social Security analysis to give you the different pros and cons for those options, but deferring it's going to increase those payments for the rest of your life and potentially your spouse's life if you happen to go before. You may decide to work part-time, maybe because it's something you need to do, or maybe it's something fun you want to do. Maybe you want to go work at the local hardware store or something like that, or maybe you want to work on a board for a charity and they may actually pay you a little bit. You are also probably likely, hopefully, have saved up and you've got some savings and investments, whether it be through your 401k. Maybe you're lucky enough to have a pension that's going to pay out as well. These are some of the different income sources you may have. You may have rental income or other options like that as well. But the question becomes, how do I juggle that? How do I actually recreate my paycheck, if you would, from those and do so in a tax favorable standpoint? As far as, what are you planning for retirement? Everything kind of revolves around that budget. And I can tell you, over the last 25 years, doing this, the biggest aspect is be true to yourself and what you think that budget's going to be, especially what we've seen the last couple of years with inflationary pressures. We may think something costs $1,000, and then everything kind of goes up. It's getting more and more expensive every year. Where you might have said, "Hey, I can retire on $5,000 a month," but in reality, it was going to be $5,500 or $5,700 because just inflation on everything across the board has kind of crept in. So we can give you a budget worksheet, but work on that and be honest with yourself and be more conservative and err towards the higher side of things. Because if you get this wrong, everything else is wrong in that financial plan. If you come in and tell me, "Hey, Wesley, I'm going to spend $6,500 a month for the rest of my life," and we budget the strategy for that, but in reality, you're actually spending $8,000, that $1,500 difference can be huge over the long term. Also, we were looking at, when you're running a financial plan, be conservative as far as the rates of interest you're looking at, compounding there as well. Just a small tweak between a 6% or 7% can be huge as far as what you may think you're going to have at the end of your lifetime. If we run this financial analysis for you, we're going to try and make sure that we're conservative on the aspect of you understand your budget, and then also making sure that we have higher than average inflation there and lower than average returns in there, to make sure that if we are telling you, "Hey, you are already retiring, you can do so," we're going to be certain about that. As far as different income sources, let's kind of go through some of these different items. Doesn't mean we're recommending one or the other, but the unique option is that we have access to all of these. So again, like I said, instead of being, let's say, an insurance agent that only has access to annuities, or a stockbroker only, selling stocks or bonds or mutual funds, we have the option to kind of do one and all for you if you need to. So our goal is to run through that financial plan, find out what you're trying to achieve, and then present the different choice of how to achieve that and go through the pros and cons of those. So different income streams would be, annuities, dividend stocks, interest from fixed income securities, whether it be, CDs, money markets, bonds, in some cases, real estate investment trust, private credit, things like that. Really, most people tend to look at portfolio diversification using a combination of some of these. And we'll talk a little bit about managed payout mutual funds, something a little bit newer that we don't necessarily recommend, but at least we'll throw it out there so you have the information on it. So annuities are going to be a little bit more detailed. This is one that we're putting in here just because, we get a lot of different questions about this. And, every time you turn on the radio, you're going to hear somebody talking about, safe money this or safe money that, and the guaranteed income. And I can get you 10% guaranteed. You need to be very careful about understanding all the ins and outs of these. So any questions you have on them, feel free to run them by us. We can definitely dig into it. They are good for the right situation and the right person, but they can definitely be bad for the wrong situation or the wrong person. So be very careful about that. There's a lot of different nuances to them as far as restrictions and potentially high fees depending upon what you're looking at. So, but from a basic standpoint, think about annuity kind of like Social Security. It's going to provide a guaranteed income source for the rest of your life, no matter what happens. Now, the difference as far as how is it providing that, is it immediate? Is it deferred? Is it fixed, or is it variable? So a lot of these questions are going to come about, whether you're going to turn that on immediately, or you're going to wait for a couple years before you turn that income on. Is it going to be fixed for the rest of your life and it's not going to have any cost of living adjustments in there? Or is it going to be variable, where it could go up or down depending upon the way you structure this? So we can dig into some of those. But the downside on a lot of these is, typically speaking, especially on a classic annuity like you see in a pension or Social Security, well, minus Social Security, but usually if you die, you're going to lose that. Now with Social Security, you get spouse continuations. With a pension, you might do a joint survivor annuity, but you're going to have a reduction there as well. And if you got questions on your specific pension plan, if you're lucky enough to still have one, give us a call. We can run through the full analysis to give you all those different options side by side. And in some cases, you may have a pension and take a lump sum and do a private annuity because you got more flexibility instead of losing that if you pass away, or instead of nobody beyond your spouse getting something. You can do a private annuity where you may be able to have a cash refund, or you may be able to name beneficiaries beyond your spouse there as well. So going into the different options, single, premium, or immediate. So again, I just provide you, those are going to provide you with a fixed income stream that's going to be fixed for life. Let's say you go through there and it's going to give you $2,000 or $3,000 a month for the rest of your life. That may be great right now, but in 5, 10 years, that may not stretch as far. So you need to make sure you're budgeting or planning for that. There are some options on the private side. You can put a cost of living adjustment in there or an inflationary adjustment. Some of the drawbacks, again, means losing a portion of your funds. You have to earmark money in order to do this. So you're giving up the potential returns on that, but you're also insuring it as far as the fact you're going to have that income there. That's what an annuity is. It's insurance on your income. They may limit the inheritance to your heirs, again, because if you're taking that out of your account, that's money that you may not be able to pass on. And again, the inflation issue becomes a potential scenario to be aware of there as well. So fixed annuities versus variable annuities. So again, this is going to be the amount that's coming out to you. Both are going to provide that income. The fixed annuities, if you look at an FIA, a fixed indexed annuity, it's going to provide downside protection with limitations on the upside. So be very careful. This is what you're typically hearing on the radio. Somebody telling you that we can get you 10% guaranteed growth. That 10% guarantee is on the benefit base. So that's what they use to calculate income on, and you're going to pay a fee for that as well. So you want to go through the ins and outs of that, we can definitely do so. I'll be honest with you, I can probably look at 100 and tell you there might only be 2 or 3 that make the most sense for somebody at that time, or there may be 0, depending upon your situation. So be very careful about a one-size-fits-all scenario there. But again, they're going to be generally safer because you're not going to lose money, but you're also not going to potentially make money. So a lot of times they put different limits and caps on there where, let's say, it's tied to the S&P 500, but it's got maybe a cap of 6% or 7% for the year and only a participation rate of 60%. So let's say if the market goes up 10% and you got a 60% participation rate, you're only getting 6%, and the cap may be 6%. So you're good there. But if the market goes up 20% and you've got a participation of 60%, you're getting 12%, but the cap is 6%, so you're still just getting 6%. So really, it's kind of a bond alternative. But again, if you're looking at doing those for income purposes, they can be good. But be very careful about how you structure those. A variable annuity on the flip side is going to put more of the risk in your hands. It's going to allow you to potentially invest in mutual funds and other options to potentially grow that amount at a higher rate and potentially give you a cost of living adjustment. But at the same time, it could mean that you spend that down sooner. If you're adding a income rider on there, where you're going to get a guaranteed income for life. That's going to give you that core base, so you have that potential to grow it. But a lot of times it's hard to do this because of the fees associated with it. But both of these, one benefit in them is if something happens to you sooner rather than later, you still potentially have assets to pass on to your beneficiaries, whether it's your spouse or whether it's kids beyond that point. As far as generating income from interest and dividends, this is definitely something that you've kind of done within your 401k plan, and a lot of us do in IRAs. But what's going to happen is most investments, ETFs, mutual funds, stocks, they're going to generate they're going to generate dividends. Some may not, but some will. You may also have interest, whether it's kicked off from a CD, a money market, treasury bills, bonds. That's another way to generate some interest on there as well. But it does allow retirees to receive a regular amount of money. Now, the difference is, unlike an annuity, it's not guaranteed. So again, you could see a potential company that's issuing a bond go under. You could lose all of that. You can see fluctuations in the price because of interest rates moving. Also, dividends are not always guaranteed. We go back during the pandemic, some of the dividend stalwarts, they actually cut their dividends for, a couple quarters there as well. The interest in dividend income is often taxable. A lot of times you get qualified dividends, which are going to be taxed at long-term capital gains rates, either 0, 15, or 20%. So a little bit better, but most of the time, bonds are going to kick off taxable income unless you're in a municipal there. So again, I'm going over just high levels here. So it's really best to kind of give us a call and dig into some of these more one-on-one. But another option to look at is total return investing. This is typically what we see a lot of times when somebody's used to a 401k. They want to keep a similar allocation, roll that over to an IRA, and get more diversification and investment selection in that process, or they want the expertise of us or somebody else. But that's going to focus on optimizing your returns with the diversified approach, utilizing stocks, bonds, CDs, money markets, maybe real estate investment trust if need be, private credit alternatives, things like that. But the benefit there is it's liquid, allows for flexible withdrawals. So if you need to increase your withdrawals or decrease them, you can do so. You're not stuck in any specific situation. I had a call just yesterday from a client. Unfortunately, a mother-in-law passed away, and they needed some additional income to kind of help with the funeral expenses and kind of get some things situated with the father that was still living. But the point in there is typically what we're doing is we're setting up a monthly income stream. So you may say, hey, Wesley, I need $5,000 a month deposit to my bank account, or $2,500 every 2 weeks. And then it may be something like this arises where you need a one-off. Maybe a vacation is coming up, a family situation like this or something else, you can tap into that and take that out. The question just becomes, are we going above and beyond that budget if we continue to do things like this, and how do we review whether that makes sense to kind of pare back or look at that budget reevaluation there. And as far as managed payout funds, I won't spend a lot of time on this, but some mutual funds have kind of come up with the ability to do that diversified approach with you, and they say there might be a target of, let's say, a 6% income, or a 5% or an 8% or something like that. They're the kind of new. I don't necessarily would say I'd necessarily trust all of them, because again, a lot of times you're going to have some additional embedded cost in there. But it is something that you may have been talked about. You may want to look at. If you want to dig deeper with me, we can go into that with you as well. So let's look at a very basic example. We're doing this basic just to kind of give you a breakdown as to kind of high level what you can be looking at. But let's say we got a 65-year-old couple. They need $6,000 a month, so what's that, $72,000 a year to live off of. They're lucky enough to have a good combined Social Security of $3,000 a month, so they're halfway there. Their gap is only $3,000 a month. So what's that, $36,000 a year that they need to generate off of a $1 million portfolio. So again, did really well savings here. So that's not that bad. I mean, so 36,000, that's 3.6% withdrawal rate. So not really a hard example that we're looking at here. So the question is, how can I generate that? I can go out there and just tell you, hey, you can look at, Treasury money markets paying, 3.5 to 3.75 right now to give you what you need. But that's not going to be good, because again, if interest rates go down, which they're on that move downward right now, it's not going to generate as much. And a lot of times that's really just kind of keeping up with inflation. You're not going to see any growth there. You can go out, you could buy a fixed annuity that is like a CD that's going to be paying, closer to 5% or so. And you can get that plus a little bit on top of there if you're super, super conservative. But typically, most people aren't going to do that. They don't want to lock up all that money, and we don't recommend that. So usually look at kind of a combination strategy. It could be where you're just looking at a diversified portfolio, and we're shooting for, trying to get that, 5 to 6% rate of return, so that you can kind of compound that. And you can build up those assets to help with the cost living adjustments there over time and pass that on. Or you could say, I want to kind of strip this out and look at different goals. So that's what we did here. Let's assume this couple said, Wesley, we're getting the $3,000 a month from Social Security. We need $6,000 to live on, but really there's about $5,000 we want for kind of like essential expenses, and we want to make sure that's kind of guaranteed. So maybe they go in there, they look at doing an immediate annuity, and so what it may be that if they're looking for just simple flat, want to kind of recreate Social Security or a pension, maybe it's going to cost them $360,000. We have to look at these on different rates now. But maybe it's going to cost them $360,000 out of that portfolio to give them a guaranteed $2,000 a month. So now they're at $5,000 a month. Their gap is just $1,000. And they may say, okay, well, now we've got that $1,000 a month. We're pulling that out of the 640 or so. Let's go and do a buckets of money strategy. Let's set aside $40,000 in a money market that's going to get close to that 3.6%. And let that kind of satisfy us for the next 2 or 3 years, and we'll look at the rest, that 600,000 or so, roughly. The rest of that 600,000, we can look at diversifying that in a conservative strategy, so that way it will continue to hopefully grow. But even if that's a pullback, it's not going to affect their plan for the next couple of years. But the hope is that 600,000 is going to spin off more dividends and interest that can just be moved over to that money market annually to kind of replenish that 40,000. So they're able to kind of keep doing this cycle. So again, very, very basic example, but it just kind of gives you that breakdown as to kind of a diversified strategy there. Now, as far as tapping into your 401k, because a lot of you, have 401ks and you're getting your contributions plus company match, hopefully. But qualified distributions that you take out from pre-tax money, that's going to be taxed at your ordinary income, and it could potentially have a 10% penalty if you're taking it out under age 59 and a half. Unless you retire at 55 or later. That's an age 55 rule we can go through with you when we're running that review to let you know what your options are there. There are some ways to get away from that 10% penalty if you need it. If you put in some after-tax money, then that's going to be tax-free. So the cost basis is going to be tax-free when you take it out, or you can roll it to a Roth IRA so it grows tax-free. But the growth that's in there is going to be taxable still. So let's say that over time you've put in $20,000 after tax, and it's grown to $35,000. So that $20,000 you put in, that's going to be tax-free because it's your cost basis. But that $15,000 in growth, that will be taxable eventually when you take that out from the 401k or take it out from the IRA if you roll it over as well. And the Roth 401k, if you've got that in your as an option in your 401k, those are going to grow tax-free. So in that same situation, if you put in $20,000 over time into a Roth 401k, that 15 grand in growth is actually tax-free. So the full 35,000 could be rolled over to a Roth IRA or taken out tax-free post 59 and a half. So I talked a little bit about rollovers. I mean, typically speaking, we see 95+% of people once they retire from their and leave their 401k, they're going to roll it over to an IRA, just simply put, because there's more investment choices, whether they're doing it on their own or working with myself or another advisor. There's just more choices. Usually a 401k may limit you to 10, 15, 20, 30 choices. Some are only 5 or 6 choices in there. So you don't have that much selection process. Some people may like that. They may like the simplicity, not having a lot of stuff that's overwhelming them. You get over to an IRA, now you got thousands of different choices and options available to you. If you want to do it DIY, that's great. If you want to work with somebody like us, then we can kind of help whittle down those options and kind of go through and explore the best options for you now, and also go through and let you know how these options can change, because what may be beneficial for you right now may shift and change over the next couple of years as you transition through retirement as well. But if you do a rollover, there's going to be no taxes associated with that transition because you're not taking money out. But if you do take money out eventually, that's where you're going to be looking at paying taxes. You'll also have the RMD on the pre-tax money, whether it's in the 401k or whether it's in the traditional IRA. We'll go through that on the next slide on what those RMD ages are. But if it's that Roth account, that's going to grow tax-free, assuming that you've kept that in there for 5 years and you're over 59 and a half as well. As far as the RMDs, that's the required minimum distribution. That's where essentially the IRS comes knocking on the door and says, hey, we've been giving you this option to defer these taxes all these years. Now we want you to start taking it out so we can tax you on it. The good news is that used to be 70 and a half, but the Secure Act, first Secure Act pushed it out to 72, then Secure 2.0 pushed it out to 73 and or 75. So either you are taking your RMD now, or if you're born in the 50s, you'll have to take it at 73. If you're born 1960 or later, you can be taking it at age 75. Who knows? They could push that back again another time in the future. But that doesn't mean you can't take it. What that means is between 59 and a half and 73 or 75, you've got flexibility to take what you want when you want. Once you hit 73 or 75, then you have to take it no matter what. And it's a percentage basis. We'll show you on the next screen or so. But what it means is, in those years prior to that, we're going to do a lot of tax planning strategies with our clients where we're going to determine, does it make sense to do any Roth conversions to get some of this IRA or 401k money transitioned into a tax-free account. So that way it's going to reduce your RMDs. And because what's going to happen is once you hit that RMD age, it has to come out no matter what your tax bracket is, no matter what your income is. So if we can manage that and give you a lower required distribution and give you the ability to pick and choose, do I want to take from my IRA or my Roth IRA or my brokerage account, you can budget and plan your taxes better. When I would say that it's a safe bet, we might see higher taxes somewhere down the road in the next 20 years or so. And failure to take those RMDs can be a penalty. It used to be as high as 50%. It's come down now, so it's not quite as high. And there's other differences. If you don't need the RMD, you can do a qualified distribution where you can get that over to a charity. There's also options, a QLAC where it's a qualified lifetime annuity option where you can actually defer out some of your RMD on a one-time basis with different limits. So we can go through all those with you as well. As far as when it comes time to take that RMD, we got a busy chart here, but the simple answer, just to tell you, is there's a divisor calculation based upon your age and based upon the balance of your account at the end of the last year. But simply put, it's roughly a little bit below 4%, kind of grows to about 4%, and then it's going to get higher and higher each year. So let's just say you got $1 million portfolio, roughly you're going to take out close to about 40 grand or so from there. And also keep in mind that the breakdown of it, the IRS doesn't care if you have one IRA or 100 IRAs, they just care about the total amount. So you can have the situation where you might have 3 or 4 different IRAs and you're taking all those distributions from one single IRA because of the way you've structured that plan. So again, any questions on there, just reach out, give us a call on there. And then I'll kind of wrap this up and then kind of do a quick refresh and then we'll get into some questions. But biggest issue right now, about 3/4 of Americans still don't have a written plan. 3/4 of Americans over 50 don't have a written financial plan. One of the things we've always kind of prided ourselves on is running that financial plan, complimentary for our clients and prospects. So if you've got questions, want to run that, just give us a call. Spend about maybe 10 minutes or so gathering some data. Give us a couple of days to put together that detailed financial plan. And I really call that the rough draft, if you would. Once we run through that with you, you might see how it works and say, oh, wait, okay, let me change my budget here. Let me look at this. Let's back out the mortgage because that's going to get paid off. Let's look at these other assets I have. So if you want to go through that, and especially if you're thinking about retiring soon, you want to weigh the pros and cons of when to retire, how's your pension affected, how's your 401k affected, that's really good to run through that cash flow analysis as well. And if you've done one with us before, but it's been a couple years, hit us back up because again, things have obviously changed in the last couple years with interest rates in the market as well. This is one we've always kind of had up there with the retirement group. Again, now we're part of Wealth Enhancement Group, but the history still stays the same. A team that combined with over 150 years of experience working specifically with corporate employees and helping them transition into retirement. Again, like I said before, myself and some other and our advisors all kind of are assigned or work with a select few companies so that we know their plans inside and out, so we can kind of hold your hand through that process. Make sure when you do decide to leave, you're maximizing your benefits, whether it be the pension, the 401k, healthcare, retiree, medical benefits, life insurance continuation, things like that. We've got offices across America. That slide we showed before, again, we're actually up over 160 plus offices across America with Wealth Enhancement Group. So chances are we can take care of you face to face. But if not, we can have web meetings, phone calls, whatever your preferred communication method is going to be. And again, like I said, that complementary cash flow analysis that we had on there. And I'll leave this up, get into some of the questions. But if you want to schedule a meeting with myself or one of the other advisors, you can use the QR code here to get into that. There's one to get into LinkedIn if you want to have us update you on future seminars, or maybe you want to find out seminars on your specific company plan. You can call us at 800-900-5867. You can also email us at info@theretirementgroup.com, and we'll set some time and either reply to your email, answer your question, or set some time to go over some information you may have questions on. But I'll knock out two of these questions just for sake of time. But the first question in here, what happens if I get laid off? How can I access my 401k? Okay, I know we kind of talked about 401ks. I threw out some different options as far as retirement, and I think the age 55 rule. But if you get laid off, and unfortunately we're seeing that a lot, and we've seen that a lot over the last couple of years, and we'll probably continue to see that. The question becomes, how do you access it? Some of that's going to depend upon your age as well. But typically speaking, once you leave the company, it may take a pay cycle or so for them to put that last paycheck in there and officially terminate you or separate you. But once that happens, that's completely portable. You can take that, you can withdraw it, or you can roll it over to an IRA. But I would kind of I would pause there to find out a couple things. Number one, how old are you? If you're over 55, let's say if you're between 55 and 59 and a half, then I might say, let's review keeping money in that 401k plan. Most advisors might say, yeah, giddy up. Let's get you rolled over so we can manage this. But if you're between 55 and 59 and a half, it may make more sense to either leave that all in there or leave a portion there so you can access distributions without that 10% penalty based upon the flexibility of the age 55 rule. And there's other options with the Rule of 72T and an IRA and first home purchase, education expenses, things like that, where you can get around that 10% penalty. But that's a simple one within the 401k plan. If you're under 55, then we'd have to go through one of those other options to try and access it. I would actually say that it would probably make more sense, especially under 55, to roll over to an IRA before you take any withdrawals, because with a 401k, you tend to have a fixed 20% withholding. So it doesn't matter if you're in the 12% tax bracket or 22 or 24, they're going to withhold 20%. So if you're in that 12% bracket and you're taking money out, you're essentially giving the IRS interest-free loan for a while until you file your tax and get that money back. But if you roll to an IRA, you're able to dictate exactly what your tax withholding is going to be. So again, more flexibility there. Another question: how do I choose my pension options between a lump sum and annuity? Okay, this really. It's a plug. I'll just go back to that cash flow analysis because I can't really answer specifically. But the cash flow analysis we can run is going to give you the ability to kind of run those side by side and say, okay, I'm looking at retiring in 2 years, and this is my pension calculation the company gave me. Here's my annuity payment single. Here's my annuity payment if I do joint survivor with my wife or with my spouse. Here's my option if I take a lump sum. So we can actually run all those side by side and show you how it looks, not just now, but how it looks in 20 or 30 years. Generally speaking, just to kind of be a little bit general here, if you're somebody who's got some spending issues or things like that, or has some concern about managing your own money, then it may be beneficial to take that annuity so you get that steady stream of income. However, again, that steady stream of income is not going to grow with that pension. So it could be important to look at maybe taking the lump sum and doing a private annuity that gives you some more flexibility for yourself and your beneficiaries, depending upon interest rates at that time. Or if you're saying, hey, I want to grow this, I want to make sure that not just myself or my potential spouse, I want to make sure my beneficiaries beyond that get something out of it, then you might want to look at the lump sum And as long as you're able to manage that appropriately yourself, or work obviously with Wealth Enhancement Group or another firm, then the goal would be to try and meet and exceed that annuity payment and continue to grow that portfolio so you've got more money to pass on to your beneficiaries as well. So again, just give me a call. We can kind of run through your numbers one-on-one and side by side to show you how those look. So anything we didn't get to, we'll shoot you an email or we'll give you a call back. But again, one last piece of disclosure. Even though I said we work extensively with a lot of companies, have been for 20 plus years, that does not mean we're employed by them. Again, our advisors know the intricacies of these plans inside and out, but we're not endorsed or employed by those specific company. But again, we'll be happy to be your first stop if you have any questions on there, and we can give you all the information. And if you want us to point you back to HR to confirm that, we can definitely do so as well. So I want to thank everybody for joining us. And again, this was a little bit more generic, but any questions, just give us a call at 800-900-5867. Thank you very much. You have a great day.